Session 5 will talk about monetary sovereignty and the path towards digitalization of money. The session will be chaired by Deputy Governor Roberto Tangonan of the Payments and Currency Management Sector of the Bangko Sentral ng Pilipinas. Deputy Governor Roberto Tangonan is the head of the Payments and Currency Management Sector of the Bangko Sentral ng Pilipinas, tasked to address the interplay between digital money and physical currency and support the digital transformation of the Philippines' financial services. He leads the payments and currency management sector in maintaining the safety and integrity of the Philippine currency, as well as ensuring a well-functioning payments and cash ecosystem that fosters long-term economic growth. He brings with him over 28 years of experience in digital and traditional financial services, telecommunications, technology, financial inclusion, and consulting services. Deputy Governor Tangonan took his bachelor's degree in civil engineering from the University of the Philippines and his executive MBA from the Asian Institute of Management. Deputy Governor Tangonan, you have the virtual floor.
Thank you very much, Vic. Good afternoon and good morning to our esteemed panelists and also to our distinguished audience who are with us in this session. This is the panel discussion on the monetary sovereignty and the path towards digitalization of money. Just to give a brief introduction for the benefit of our audience, so the rapid rise of privately issued cryptocurrencies with no central entity to back them pose stability and security risks, but also threaten monetary sovereignty. This development led central banks to explore the possibility of issuing CBDC, a digital legal tender with sovereign guarantee. Completely altering forms of money and credit would have massive implications on the way financial markets operate and consequently on the conduct of monetary policy. National payment systems are still intrinsically linked to bank accounts. Thus, a CBDC would transform the relationship between banks and the central bank. By expanding the reach of central bank accounts to non-bank providers of payment services, it can foster deeper innovation and competition in payment services, but at the same time, reduce the role of banks. CBDC is also seen to mitigate the risk of bank runs and do away with a lower bound for interest rates, giving central banks more flexibility during deflationary episodes. An important first step is for the central bank to clearly establish the purpose and motivation towards its consideration of a CBDC. The purpose would guide the subsequent decisions on the form, design, and attributes of the CBDC. Depending on the design, the CBDC could help enhance monetary transmission mechanism, or it could reduce financial intermediation, or it could blur the lines between monetary and fiscal policies. These are only a few of the potential consequences that require careful deliberations. There are also trade-offs involved, such as balancing between efficiency and privacy issues. There are incongruities as well. While a common goal is financial inclusion, the level of technology could, to some extent, exclude the least technologically literate segment of the population. So to cover this topic and discuss with us more on this session, we have esteemed practitioners and central bankers. We have two central bankers. One is also working for a standard-setting body, the BIS, and we have a deputy governor from a fellow ASEAN country, and we have a a legal professional, an expert on financial regulation, and also perhaps it's fair to say, a technologist from Accenture, blockchain, and multi-party systems. So before we go to the session itself, allow me to introduce our esteemed panelists. The first presenter is Mr. Benoit Cour. I hope I said that properly. He became the head of the Bank for International Settlements Innovation Hub in January 2020. He is a member of the BIS Executive Committee. Previously, he was a member of the Executive Board of the European Central Bank, responsible for market operations and European and international relations. From 2013 to 2019, he chaired the BIS Committee on Payments and Market Infrastructure and was a member of the Financial Stability Board. Prior to joining the ECB, Mr. Benoit served in various positions at the French Treasury. He was Deputy Chief Executive, then Chief Executive of the French Debt Management Office, Assistant Secretary for Multilateral Affairs, Trade and Development, co-chair of the Paris Club, and G8 and G20 finance, not sure how to say this properly, Stu Sherpa, then Deputy Director General, Chief Economist of the French Treasury. Benoit is a graduate of the École Polytechnique in Paris. He holds an advanced degree in statistics and economic policy from the École Nationale de la Statistique, and a bachelor's degree in Japanese. He has authored articles and books on economic policy, the international monetary system, and the economics of European integration. Benoit will be followed by DG Mati Supapong. He has been the Deputy Governor of Bank of Thailand, in charge of monetary stability since 2015. He also currently serves on the BOT Board, the Monetary Policy Committee, and the Financial Institutions Policy Committee. Mr. Mati joined the BOT in 1985 and had extensive experience from various positions in international monetary policy and economic research departments up until 2005. Since then, he assumed directorship of several key departments: Domestic Economy Department, Monetary Policy Department, and Risk Management Department, prior to his appointment as the Assistant Governor for the Monetary Policy Group in 2014. Next panelist we have is Professor Christina Skinner. She's an expert on financial regulation, as I've mentioned earlier. Her research focuses on central banking, the debt markets, separation of powers, corporate governance, and law and macroeconomics. Her research has been published or is forthcoming in the Columbia Law Review and the Duke Law Journal, the Vanderbilt Law Review, and the Georgetown Law Journal, among other leading academic journals. Professor Skinner has also contributed to financial regulatory policy working groups, including those convened by the Federal Reserve Bank, the Financial Stability Board, and the UK Banking Standards Board. Prior to joining the faculty at Wharton, Professor Skinner served as legal counsel at the Bank of England in the Financial Stability Division of the bank's legal directorate. Her work there focused principally on matters of bank resolution, financial market infrastructure, and macro-prudential policy. And last but not least, we have Dr. Usman Mandeng. He's a senior advisor with Accenture's blockchain and multi-party systems and co-leads Accenture's campaign globally for the dissemination of central bank digital currencies and thought leadership on the wider implication of the digital transformation in payments. He has worked more than 20 years holding senior positions in financial markets on official financial institutions, coverage, and the International Monetary Fund. He has commented regularly on the international monetary system and is a visiting fellow of the London School of Economics and a member of the Bretton Woods Committee. He holds a PhD from the London School of Economics and Political Science. So welcome again, once more, our dear and distinguished panelists. This promises to be an interesting panel discussion. So to kick us off in our session is we start with Benoit, who's going to speak on monetary sovereignty and the path towards digitalization of money. Benoit, you have the floor.
Very much. Thank you very much, Mert. Good afternoon, and thank you for having me here. And it's a pity that we can't all meet in Manila, but that will be next time, I guess. And I'm happy to kickstart our discussion from the perspective of the Bank for International Settlements. As you know, the BIS is working on behalf and supporting the central banking community. We really want to act as a convener and to support joint work by central banks, particularly in the innovation field, and that's what the BIS Innovation Hub is about. And CBDC, central bank digital currency, has been identified, of course, as a key priority for the BIS Innovation Hub. So as a warm-up to our discussion, I thought it could be useful to share some of the perspectives of the central banking community when it comes to the future of money and payments in a digital world. And starting with the first slide, so if you can move to the first slide. Thank you. Let me start with a few facts, and these are already outdated. As a matter of fact, the BIS every year runs a survey among all central banks in the world on their engagement on central bank digital currency, and that's the outcome of the survey that was run at the end of last year and 2020. So it's almost 1 year old now, and you can see that already at the end of 2020, 85% of central banks globally were engaged in work on digital currency. And already a lot of them had already moved to either experiments or proofs of concept, which you can see on the right-hand side of this slide. 60% of central banks running experiments or POCs for various aspects of CBDC, and already 15% of them were already rolling out pilot experiments for CBDC. And that was 1 year ago, and you see how steep the curve is. And so you can expect that when we release our next survey in early 2022, the numbers will be even higher. And so it's worthwhile reflecting on why the curve is so steep and what has prompted this very, very strong interest of central banks into digital currency. And moving to next slide, you will see two very nice pictures. But before explaining the pictures, let me take a step back and look a little bit at recent history. When you look at the way the payment world has evolved over the last years, one way to summarize is to say that innovation has started at the front end of the payment world, improving payment interfaces, client interfaces, interfaces at the point of sale, mobile interfaces, as we all know, and we're all using them now, mobile QR codes, and so on. And that was very much at the front end of the system. And the core of the payment system, that is large value payment systems, RTGS systems, as we call them, hadn't really changed for the last 20 years. But what we've seen emerging over the last 3-4 years is innovation creeping into the heart of the system, the back end of the payment system, with a number of proposals to develop closed loop systems, and certainly the DM proposal, the Libra proposal by Facebook gathered a lot of attention, but it's not the only one, which came with a promise of interconnecting financial intermediaries, interconnecting jurisdictions in an entirely different way, particularly building on the DLT technology. And that was a promise of new closed-loop payment system that would entirely shortcut traditional RTGS systems. Which brings me to the pictures here, and you have a little bit two different models here. You have the walled garden model, that is a closed-loop system managed and controlled by a private company, which you see on the left-hand side of the slide. And on the right-hand side, you have the public square model. That is, anyone can move in and out. You can have your own outlet, your own little stand on the public square, and all you need is adequate regulation, entry rights to support this open concept. And increasingly, the official community, public authorities, not only central banks, but also ministries of finance and regulators, have become concerned with the first model, the walled garden model. And the fear has emerged that this would entrench the market power of big tech companies by allowing them to build market power in the payment universe, building on what they've already achieved in other areas. And that this walled garden concept could possibly be harmful to liquidity and to the universality of money, to money being fungible across different use cases, money flowing freely across the system, and also possibly could be detrimental to innovation. While we know for sure that an open finance model where you allow entry of new actors, new entrants, be they banks or non-banks, based on adequate regulation, can be favorable to innovation and to competition. And so, what's the conclusion for the central banking community? Moving to the next slide. Thank you. The conclusion is that one adequate way to build this open finance approach to innovation and to the digitalization of payments is to build it around currency issued by the central bank digital currency. And there are different reasons for that. One reason is that as a settlement asset, central bank money is the safest possible settlement asset because it is a claim on the balance sheet of a central bank, and the central bank cannot go bust, will never go bust, because it can create its own money. So it's the safest of all possible settlement assets. And finality is best ensured by settling between accounts on the balance sheet of central banks. So it's also a matter of legal certainty and financial stability. Central banks can create money in case of need to inject money into the system. And we've seen back in 2007, 2008, and again last year with the pandemic, how important this function of a lender of last resort is to provide stability to the system. And this can only be provided by a central bank. That is a closed loop model that does not have in itself the ability to stabilize the system by injecting outside money. You need the central bank to step in. And also the central bank is neutral in the sense that it doesn't have any commercial interest. So it's not in the business of building market power. We're not interested by that. We are interested in building a level playing field that is open to all players. That doesn't mean that all digital money has to be issued by the central bank, of course. It's very much about having an ecosystem with all kinds of private players coming in, including private digital currency, including stablecoins, provided that they are well regulated. But central bank money remaining at the heart of the system, as it is today, is a promise of more stability, and it's also the promise of more openness and competition. Now, there are many different ways to do it, and I very much look forward to the discussion that we're going to have on this panel, because there are different approaches to CBDC. Moving to the next slide, you can see, for instance, that there are three possible architectures for CBDC. You have the direct model, where CBDC is issued by the central bank and directly distributed by the central bank to all players in the economy. That's the direct model. At the other end, you have the what we call here the intermediated model, which you could call also the indirect model, where CBDC is issued by the central bank to intermediaries, and then intermediaries issue commercial money to households and firms and SMEs and so on at the front end of the system. acting as narrow banks, if you want, but backed by central bank money. So that is the intermediated model. And at the center, you have what we call here the hybrid model, where CBDC is a liability of the central bank. So it is a claim on the central bank, but it is being distributed by private financial intermediaries. So at the left hand of this chart, you have the promise of stability and safety provided by money being a direct claim on the central bank. At the right-hand side of the chart, you have the promise of alleviating the burden on the central bank by relieving the central bank from onboarding clients, doing KYC, checking anti-money laundering requirements, and so on, which is best done by private intermediaries under existing regulation. And the hybrid model at the center is a little bit the best of both worlds, which is why I would personally expect it to be chosen by many central banks as a way forward to issue CBDC. CBDC being a claim on the central bank, but being distributed by private intermediaries. Should these intermediaries be banks or non-banks? That is an open question, which very much depends on the financial structures in different jurisdictions, and whether they are banked or bank-based or market-based, and there can be different answers to that. There are many other questions that you can ask and that central banks are asking themselves about CBDC implementation, and you have the flavor of these questions on the next slide. So I'm not going to go through all of these because that would be a very long discussion, but there are clearly choices to be made when it comes to openness and access. As I said, do you want to give access only to banks or also to non-banks? And I'm pretty sure that there will be different answers in different places to that question. What is the best regime when it comes to privacy, which obviously will be a very important question for citizens and for the political acceptance of CBDC. Who's going to have access to client data in that kind of architecture? Should the central bank have access to client data? And again, I would expect different answers in different places. In Europe, for instance, which is a place where I come from, I would clearly expect the answer to be that the central bank should not have access to individual data, and that individual data should be managed by financial intermediaries under data protection regulations. So in Europe, namely the GDPR or similar regulations in other places, but there could be different models. So this will be one of the defining questions to be answered. And of course, you have technological questions. Should CBDC be account-based or token-based? And we can come back to that in the discussion. And you have questions related to international openness and international integration. Do you want your CBDC to be used outside of your borders? Do you want it to be disseminated widely globally or not? And that also relates to your objectives in terms of financial openness or in terms of capital control and so on. And so again, there will be different answers. So there is no one-size-fits-all model for CBDC, but the common theme will be that CBDC, being at the heart of the system, will be there to bring stability and to be the promise of an open environment, provided that it can interoperate with other private initiatives. And that's, I think, what will be a key discussion over the next years will be how to achieve this interoperability between CBDC and other means of payments, be they traditional payment systems, RTGS systems, fast payment systems, or be they private forms of digital money, including stablecoins. And that has to be also a technical discussion. I end my presentation with 2 slides, going very quickly. On the next slide, you can see that CBDC doesn't have to be everywhere in the system. I very much see retail CBDC as an option which is being provided to citizens, to customers, to households. They don't have to use it. And lots of them will keep using commercial money, that is plastic money, mobile interfaces plugged into their bank accounts, and that's commercial money. But as a principle, citizens should be able to use central bank money, and with the use of cash going down very fast, CBDC has to be an option that has to be offered to citizens, and then they can decide whether to use it or not. which is also the answer to lots of the concerns that have been raised by financial intermediaries, including by banks. Banks are worried that retail CBDC could crowd out bank deposits and harm their funding models. I think the answer to that is that CBDC can be designed to have a limited footprint in the economy, just like banknotes today have. And here, as an example, you see the footprint of cash compared to bank deposits, and you see that cash is very limited compared to bank deposits. So if you see retail CBDC as the digital equivalent of cash, then it doesn't have to be a threat to bank deposits. It's an option offered to customers, but it's not going to dominate the future system. Finally, my last slide will be the next one, and I won't use the last one. Just to emphasize the importance of the international dimension of CBDC, with different countries moving to CBDC, interconnectedness and interoperability between CBDCs will become a key issue. The BIS Innovation Hub is preparing that discussion. We are working on what we call multiple CBDC platforms that will connect different CBDCs. And as it happens, we've just announced this morning a new step in project N-Bridge, which is a joint project with the Bank of Thailand. It is inherited from the Hong Kong Monetary Authority and the Bank of Thailand, initially called Lion Rock Internon, as many of you know, and now extended to include the Central Bank of the United Arab Emirates and the PBOC, or the Digital Currency Institute of the PBOC. The prototype that we've built together shows that by linking CBDCs on a common platform, you can achieve significant gains in terms of, particularly in terms of speed of execution. So discussing CBDC in one country is not enough, and discussing how to connect CBDCs will have to be part of the discussion. And I think I can stop here, Mert. We'll be happy to be a part of the discussion.
And for that very informative presentation. So I'm sure we have questions from the audience, but before we go to the questions portion, I would like to let the panelists deliver their presentation or share their views on this subject. So the next presenter is DG Mati of the Bank of Thailand, and he's going to present and share with us the Thailand's journey towards CBDC. So DG Mati, the floor is yours.
Thank you, Chair. First of all, I would like to thank the BSP to give me opportunity to present our CBDC journey in this prestigious international research conference. In the first page of the slide, can you share my slide, please? Okay. I would like to summarize our CBDC project that we have done so far. As mentioned earlier, it's called the Internon project. The Internon is the name of the highest mountains and also the national park in Thailand. A motivation of the project is to learn how to apply digital and financial technology to our currency or the Thai baht amidst a proliferation of a private digital currency and asset. Our aim is also to offer reliable and trustworthy digital baht, which can be programmable and suitable for the ongoing change in the financial landscape. In addition, CBDC can be designed to improve financial efficiency, financial access, and financial inclusion, especially for the developing countries. What I have said with respect to CBDC is not meant only the token, but it includes the infrastructure, networks, platforms, so on and so forth. All this can bring about future innovations and expansions of its usage, and may be part of a new financial ecosystem. Our visions going forward, we envisage that the CBDC will be an interesting choice for general public and businesses to be used along with a banknote and e-money. It can be better alternative to private digital currency, mainly in terms of medium of exchange, for anyone who embrace innovation, who want to try something new, but also need stability values similar to the fiat money. Now going to the next slide, please. Okay. I would like to talk about our CBDC journey, which has begun in 2018. In phase 1 and 2, we experimented with wholesale interbank CBDC. There were 8 commercial banks participating in the project using DLT's infrastructure to create a decentralized RTGS system. The prototype can perform a basic payment functionalities as well as some complex transaction using a smart contract. Upon completion of the phase 2, we realized that our wholesale CBDC for interbank transactions had marginal benefit compared with our existing RTGS system that already very efficient and convenient for user. In the phase 3, we collaborated with Hong Kong Monetary Authority to explore cross-border payment using DLT. The project named Internon Lie on Rock. We completed proof of concept for a cross-border fund transfer between Thai and Hong Kong banks on P2P basis without corresponding banks, therefore eliminating settlement risk and lowering transaction costs. Our designs allow exchange rate discovery and on-demand conversion and settlement. To include more currencies and jurisdiction reflecting real-world situation, as mentioned by the previous speaker. Earlier this year, HKMA, the BIS Innovation Hub in Hong Kong, and the Bank of Thailand welcomed the Digital Currency Institute of the PBOC and the Central Bank of UAE to be part of our new CBDC Bridge project. It is still in an early stage. We hope that we will gain more knowledge and experiences to deal with the real business use cases. Now I would like to mention our journey on the retail CBDC. Last year in 2020, we started exploring retail CBDC at firm level. We joined hands with 2 local participants to integrate our CBDC system with their business platform connecting their supply chains. We have achieved key basic payment functionalities and also enhanced features such as invoice tokenization and conditional payment. Most recently, we are developing retail CBDC for general public. We have successfully completed a proof of concept for a retail CBDC prototype. Next step, we will launch a small-scale pilot, or as you call it, a sandbox, in the second quarter next year to test its performance and consumer behavior and preference, and also evaluate their feedback to help improve our retail CBDC for wider adoptions and risk mitigations. Now, coming to my last slide, along our journey, we have a number of observations and lessons learned. The first one is that 24/7 operations of the CBDC network can affect an existing payment system and may involve difficult policy issues. One way to partly resolve the issues is to operate the CBDC system during the off-out period. The second one that we observe is that without corresponding banks for cross-border FX transactions, liquidity shortage of foreign currency normally occur. Therefore, liquidity providers or liquidity saving mechanism is needed. Third, the real-time instantaneous nature of a transaction make it difficult to comply with some type of exchange control regulation if a country still have an exchange control. And fourthly, the DLT so far still have major challenges regarding scalabilities and privacy. In our case, we are trying to combine the DLT and centralized technology to realize the benefits from both ends of the spectrums. On the way forward, especially in cross-border transactions, we need to deal with the country-specific and standards and deal with the multi-currencies that may complicate liquidity mechanism and data privacy, establishment of a robust governance structure, participant criteria, incentive and fee structure, and the effects on the existing system need to be carefully and comprehensively considered. That's the end of my presentation. Thank you very much.
DG Mati for sharing with us the journey undertaken by the Bank of Thailand and also your experience through that journey. So before we start answering questions, we will allow the rest of the speakers to either deliver their presentation or share with us their views on our topic for this session. So I'd like to call on Professor Skinner to share with us your views and thoughts or experience in this topic, Professor Skinner.
Happy to. Well, thank you for having me here. Good afternoon and good morning for those of us in the US and in Europe. It's very early in the US here, so I'm trying very hard not to wake my children up, but delighted to be with you. So I'm going to loosely organize my remarks for you today around our two key themes and segments of the session. So with a focus on the US landscape. So first, I'll discuss a bit what is the US landscape for stablecoin with an emphasis on these regulatory questions. And then I'll move on to discussing where the US Central Bank, the Federal Reserve, is currently in terms of its thinking on a potential central bank digital currency, CBDC, sort of gleaning what insight I can from public statements that have been made by various Fed officials and various sort of pundits' remarks. So like I said, I'm going to focus the majority of my remarks on these issues of financial stability, monetary policy, and regulatory questions. But first, just to give you a very quick snapshot on the US landscape for stablecoin, that is stablecoins that are denominated in US dollars. So there are a number, I'm sure as many in the audience know, there are a number of US dollar denominated stablecoins right now. There's Tether, although that is actually headquartered in Hong Kong. There's Facebook's Diem, formerly known as Libra, and a couple of other big ones like USDC. And how big is this market really? Well, there's about 113 billion in stablecoin that have been issued, and the recent estimates of daily transactions in stablecoin are running in the neighborhood of 10 to 20 billion per day. So it's big, but not tremendous compared to the traditional retail banking sector, which I'll come on to later in my remarks. So let's move on now to the regulatory and policy debate around stablecoin in particular. So there have been a number of vocal detractors from stablecoin, or I'll say financial stability skeptics of stablecoin. As I just implied, this particular group of academics and policymakers, so among them I would say most notable are the economists Gary Gorton and Jeffrey Zhang, and various policymakers like Elizabeth Warren and Lael Brainerd, have really started to question the safety and the stability of a vibrant stablecoin environment. And as you'll see in the second portion of my remarks, this group of stablecoin skeptics also tends to be pro central bank digital currency. So in the main, these voices have really leaned on two historical analogies to point to these cautionary tales of having stablecoins that are outside the regulatory perimeter as they currently exist. And so I'll just briefly sort of walk you through both of these historical analogies for some insight into what these cautionary tales are and to what extent we might find them persuasive. So the first analogy that's been brought out by these group of policy experts and so forth is a reference to the U.S. period of so-called free banking. Okay, and this is referring specifically to a period of banking in antebellum United States. So that's 1837 through the U.S. Civil War. And during that time, various states allowed for greater freedom in the banking landscape. So under free banking laws, banks didn't necessarily need the state legislature to vote to give the bank permission to go into business. There were something more just like ordinary laws of incorporation that had been established for banks. So this is to say that there was no nationally uniform banking system during this time. And because the banks were not federally regulated, so to speak, they were free to issue their own notes that were unconnected, untethered to a uniform specie-related value. So what happened was that at times, this free banking landscape during that specific period of US history was pretty chaotic. And it was largely because the various notes from these different banks across different states couldn't always be redeemed at par. So notes issued by one bank might be traded at discounts that differed from their face value at another. And this really sort of sowed uncertainty among depositors across the United States, across the various states. And in the worst instances of this banking system, this free banking era, there was some fraudulent activity, and some of these banks came to be known as wildcat banks. But that doesn't seem to be the majority of instances. But anyway, it was sufficiently tumultuous that eventually the lack of a uniform currency was seen as a major impediment to the North's ability to finance the Civil War. And it was a key topic of President Abraham Lincoln's State of the Union address, to push for a national banking system that could unify the currency. So in a recent paper that's been getting a lot of attention in the stablecoin space, Gary Gorton and Jeffrey Zhang point to this period of history as a lesson for what could become the fate of a currency, of a US currency under a stablecoin regime if stablecoins are not brought within the regulatory perimeter. Now, on the other hand, there are other macroeconomic and financial history experts that have said this example is anachronism. So George Shelgin, Larry White, for example, well, they're saying, hold on, Gorton and Zhang are really cherry picking a bad example of free banking to illustrate a point that stablecoin is a financial stability risk. So free banking, they say, worked really well in other case studies in history, in Scotland for some period of time, and in Canada. And both of these economists have written extensively on free banking experiments. So they point to these examples and say, well, compared to regulated banking sectors, there are actually free banking systems that can prove more stable. These authors like Selden and White also point out that in the US free banking period and antebellum US, it wasn't so much that there was a lack of federal regulation that caused these bumps in the banking sector, but actually it was the case of bad, poorly written legislation. So some states would require that the banknotes be backed by state bonds. But if your banknotes were backed by southern states that had eventually joined the Confederacy, well, the value of those bonds tanked pretty precipitously, and those banks did especially poorly in this free banking experiment. So the upshot of this example that's being discussed pretty widely in US policy circles is that free banking in antebellum US could be an example of the perils of private money creation that's totally unregulated. But then again, maybe it's not dispositive since this was a unique period in time. The landscape is different today. We already have a uniform national currency. So we might be more persuaded to say that, okay, stablecoin is sui generis. We need to look at what each coin is actually doing and judge the need for regulation on its present day merits. Okay, the second analogy and cautionary tale about private money creation outside the regulatory perimeter, which is offered, is that of money market mutual funds. I'm sure most of the audience will know that money market funds developed in the US, at least in the 1980s, in response to regulation that placed caps on the interest rates that banks could pay. Now, money market funds, very broadly defined, they're pools of capital. They issue equity, not debt claims to their shareholders, and those claims are backed by a pool of assets. This pool of assets is comprised of a mixture of floating rate, short dated assets like commercial paper, sometimes mortgage-backed securities, agency, or GSE debt. Now, over time, money market funds have come to work like bank accounts in many ways because they've pegged the value of their shares to $1. Now, this pegging of the share to $1 and this sort of substitution for money market accounts with bank accounts, well, it became a problem during the 2008 global financial crisis when the value of the assets backing the pool declined. So, for example, some money market funds had a lot of the commercial paper of Lehman Brothers. And this one fund in particular, so-called broke the buck, which is to say that it could no longer honor that one share to $1 peg. And this was so shocking to people that had just taken for granted that $1 of a money market fund share would equal $1, precipitated a panic. And so the Fed intervened with a money market fund facility to backstop the sector, right? It recognized that there's a huge dependence on money market funds for corporate funding needs. So after the 2008 financial crisis, there was a lot of thought, not only in the US, but globally, about how to make the money market fund sector more stable. And there were a number of different reforms that were adopted by the SEC, the US Securities Exchange Commission, proposed by the Financial Stability Board, and experimented with by these various funds. Some of the two notable reforms included liquidity fees and redemption gates. But it turned out, when push came to shove, at least some of these ideas, and the redemption gates in particular, well, they only created more incentives to run, right? Which we discovered in March of 2020. And again, the Fed backstopped the money market fund in March of 2020, the money market fund sector in 2020. So now the Fed has essentially created a standing facility that can function like a discount window for markets and money market funds, which is the overnight reverse repo facility. So the Fed will take in securities owned by money market funds and exchange for cash on an overnight basis. Now, on the one hand, this was seen as necessary, maybe even inevitable, given the instability in the sector, given the money-like nature of money market shares, and the fact that they aren't federally insured. On the other hand, big picture, we're at a moment in time where ideally we'd like to have the Fed scaling back its interventions in markets and crisis era interventions. Now, the big picture here is that there's been a lot of effort and thought that's previously gone into the reform of the money market fund sector and is currently underway to think about how to optimize the mix of a vibrant markets and financial stability. But it now seems like stablecoins, to the extent that they peg their value to the dollar and are backed by a mixture of assets that are not cash, they seem to look a lot like money market funds. And again, we've spent so many times thinking about how to stabilize the money market fund sector. Is our stablecoins a game of whack-a-mole in a way that's really not helpful to financial stability? And there are those like Lev Menand at Columbia who have really made this argument and presented it to Congress in various hearings. So Lev has referred to stablecoins as teched up versions of money market funds, referred to them as types of deposit substitutes, and that might be concerning, again, from a financial stability perspective. So in summary, both of these analogies to the free banking period in the US and to money market funds are inviting policymakers and the general public to think about primarily the financial stability risks of having stablecoins sitting outside of the regulatory perimeter, which is to say being issued by entities that don't have a bank charter. So if you had stablecoins within the regulatory perimeter, regulators could at least consider, okay, what are the kinds of assets that are backing the pool? Are they short dated? Are they long term? Are they sufficiently liquid? And these are the things that we started to ask in regard to money market funds now. Regulators could also inquire, is this a fractional or a full reserve backing system? I think most people think that it's hard to imagine regulators being too worried about a stablecoin that's 100% backed by pretty liquid assets. Now, again, though, on the other hand, run a bull does not mean that stablecoins are run prone. Right now, at least, the size of the stablecoin market isn't huge relative to the banking system. And stablecoins are mostly used by specialty traders, crypto traders, not by retail customers. So all of the risks that I just outlined for you in connection with the financial stability implications are still largely hypothetical. And so one really has to balance the potential financial stability risks along with the benefits of innovation and free markets in deciding how to act. And so the big question is, if there was a bigger uptake among retail customers, what would happen in periods of market volatility? Now, of course, the regulators don't want to be caught flat-footed, so they're watching. But I don't think there's a huge urgency to address right now, at least from the perspective of the Fed. The SEC, with statements from Commissioner Gary Gensler, seems potentially more concerned, but they would probably only have jurisdiction to the extent stablecoins were a security-like investment, like an ICO, which they're not, or maybe if we did start to really think about them more like money market funds. So that's pretty much the lay of the land where the US conversations around stablecoin currently sit. So moving on to CBDC. Now, CBDC is of course related, but the debate is proceeding on a separate track. There are some who would link the two, but I'm going to try and keep the debates separate for the sake of simplicity in this brief presentation. So first, big picture, where's the Fed in terms of its stance on CBDC? Now, there are certainly at least one governor who seems to support CBDC, but it seems that on the most part, the Fed on the whole at least Fed officials have a healthy dose of skepticism when it comes to CBDC. And the headlines that we've been seeing here is that there's no great urgency to rush into a CBDC. So for example, in a speech given by the Vice Chair for Supervision, Randy Quarles, he said that there's a pretty high bar, in his view at least, for the adoption of a central bank digital currency. Now, why is that? Well, there's a lot of effort to pause a moment and think about what is the point really of a CBDC. Dollars are already traded digitally. Banks, of course, issue demand deposits that are digital. And financial institutions have balances at reserve banks, and those dollars are also digital. So as a starting point, what is CBDC really going to add to our current financial institutions, payments, deposits landscape? A digital equivalent to cash, right, retail, that's made directly available to the public, that seems to be what would be added. But it's not completely obvious that that would be desirable at the moment. And so for the following reasons that I'll outline, which are not necessarily specific to the Fed, but are things that the Fed is likely going to be thinking about in terms of the costs and the benefits of adopting a CBDC that primarily adds this retail piece to the picture. So for one, retail CBDC seems like it could really complicate the Fed's mandates, and in particular, its financial stability mandate. So here's just one example that's been discussed. a good deal. One could see how in a volatile economic environment, there could be a flight to digital dollar safety, just like there are flights to safety in the bond markets for treasuries. Now, the sudden withdrawal of dollars from the banking sector, right, bank deposits, could cause major liquidity problems for banks and precipitate more runs on banks and further instability. So we might worry about this potential flight to digital dollar safety, a flight to the CBDC and out of the banking sector. Second, we do need to think carefully about the impact on mandates of other regulators. So if the Fed gets into the business of issuing dollars that rival what the private sector does, it's hard maybe to see how the Fed and other central banks similarly situated wouldn't be subjecting itself to competition and antitrust scrutiny, and that would be sort of new territory for a central bank to grapple with. Third, there's likely to be a huge impact on the retail banking sector, as I've just been alluding to. And certainly there are concerns being voiced from the banking sector. There was a very thorough paper that was put out by the Bank Policy Institute, which is a leading industry group for big banks in the US. The overarching concern is that with the introduction of a CBDC, we could be pulling reserves from the banking sector, diminishing the fractional reserve banking system as we know it. And moreover, if banks have less funds with which they can engage in maturity transformation, that's going to not only adversely affect their business model, but bottom line, it's going to make funding more expensive for bank borrowers, which is maybe not so great. Fourth, there's a question of central bank resources, right? And this has come up in some of the other presentations as well. You know, there's always the question, does the Fed really have the resources to maintain a retail currency, especially and including that which would be required to deal rigorously with AML requirements and managing privacy concerns on the other hand? And then finally, there's a very big picture question about what is the role of a central bank in society. You know, the notion that the Fed should do a retail CBDC often goes hand in hand with some conversations, some ideas about the Fed having Fed accounts. So everyone in America gets an account at the Fed. Now, I've spoken against expanding the role of the Fed into areas outside of its core mandate for various reasons, but I've done so most vociferously in the absence of congressional instruction. So from a rule of law perspective, at the very least, I think it's decently clear that the Fed couldn't do a retail CBDC without a revision to its mandate or some additional statutory authorization from the US Congress. So ultimately, I think a lot of people in the US are wondering, is CBDC a solution in search of a problem? So David Beckworth has borrowed the phrase, is this a situation of build it and they will come, which is a reference to a classic American movie, Field of Dreams. So people are still questioning, why do it? What exactly are we accomplishing? Now, some have suggested that CBDC could be a means of furthering financial inclusion. And that's a very good goal for our society to have. But surely, I think, and many others think as well, that there are probably better, more efficient, better tailored ways to target that objective. So I'll leave it there with that big picture, high level overview of stablecoin on one end of the debate and CBDC on the other. Thank you for having me again.
Professor Skinner, those are very interesting thoughts that you shared with us, and I'm sure there will be questions from the not only from our fellow panelists but also from the audience as well. So moving on to the last presentation of his views on this subject, we have Dr. Usman. Dr. Usman, you have the floor.
Thank you very much, and sincere thanks for inviting me to this session. I greatly appreciate it. I do have a presentation. I'm not sure, are you going to show it? If not, I just shoot off. Look, I'd like to offer you a perspective on the basis of the work I'm doing with Accenture on a number of CBDC projects. To give you an overview there, I'd also like to comment on some of the remarks just made, some fairly provocative and I think, very good, I think, to stimulate the debate around CBDC. Maybe I start with the letter, since I do not seem to have a presentation. What is the point of CBDC? And sadly, yes, indeed, many central banks are still asking that question. Even in our projects, we do not seem to sort of have raised sufficiently the sort of the level of conviction. Why is CBDC a good idea in the first place? And I think I'd like to start off with the idea that CBDC is a lot about diversification in central bank mediums, to offer central bank money for new use cases, equip central bank money with new functionalities, and therefore expand its utility in large part for use cases, some of which we may not even know. So it is about really giving central bank money the possibility to sort of advance the mission of central bank, and in particular to serve as a native instrument on emerging and new platforms. So it's not really about is CBDC better. It is about CBDC is likely to be serving certain use cases more efficiently than what conventional central bank money, banknotes and reserves can do. I hope that is sort of the optic that will be increasingly adopted. Namely, let's be pragmatic here. The fact is that banknotes and reserves can only do so much. And if CBDC can do more, then central banks, I think, should consider this very seriously. So the innovation is the adoption of a new medium. And I think, we have this debate about account versus token. I find this debate rather superfluous. I think the CBDC is interesting because it's about adopting the token. The debate came because of Bitcoin, and it came because of DM or Libra. And it is because we have these new DLT-enabled financial market infrastructures where central banks have to say, well, are we going to just ignore these infrastructures, or are we going to offer a native instrument that can serve these infrastructures? So I think, it's the CBDC, it's about the medium, and hence I think, we should forget about the account-based debate, but that's just my view. When it comes to sort of historical precedents, and I'd just like to bring a little bit of perspective here, stable coins, etc. The big historical perspective, of course, are fixed exchange rate regimes, and central banks, of course, some of which are on the panel here, have pursued these regimes for decades. And the fact is, fixed exchange rate regimes are only stable as long as they are, can maintain the peg. So, this is a common problem. I think, it's something that stablecoins are also subject to, and it's nothing out of the extraordinary. And I hope, again, there as well, we will have the pragmatism by which we say, look, stablecoins really is just a tech transformation to make available a payment medium denominated in a given currency, to serve as a native instrument, for some payment use cases. So again, I think stablecoins are a very good idea, but in large part they should just be seen, not necessarily as a substitute, but just as making available, a payment medium denominated in a given currency, on a typically a blockchain-enabled platform. Also, one remark when it comes to bank disintermediation, indeed, it is featuring fairly high, in the debate with central banks. But I think here the historical perspective of the Federal Reserve itself, I think, is quite useful, because it took the US so long, compared with the European countries, to introduce a central bank, in large part because there was resistance by big banks that feared that a large government institution would crowd them out, take away their business. And hence, this is why the Fed, when it was adopted in 1913, followed this regional approach of 12 different banks, precisely to accommodate the fear that a big single institution will crowd out the banks. So we've had all these debates before. So again, I hope we will be pragmatic. Let me talk a bit about the projects we have. I think one of the key projects, and the BIS Innovation Hub, of course, is involved, is Project Jura between the Central Bank of France and the Central Bank of Switzerland. Here, the idea is to use a wholesale CBDC for cross-border transactions. And the idea really is to demonstrate to what extent, if we were to use CBDC between resident and non-resident entities, and that's really the key, if we allow an exchange in central bank money between resident and non-resident entities, we can extend the safety of central bank money for international payments. And that is really, I think, if we are concerned that we need to improve international payments, we also need to be prepared to make some significant departures of existing practices, which is the correspondent banking model. So if we can allow outright payment in central bank money, I think we will be making significant progress. Project Jura is to test the implications thereof. We will perform two types of transactions. One is a payments versus payments, so a foreign exchange transaction between a Euro CBDC and a Swiss franc CBDC. And we will also perform delivery versus payments transactions, where we will settle a financial instrument issued in France and denominated in euro, paid for in a foreign jurisdiction in central bank money by a Swiss institution. And so we will effectively recalibrate the geography of central bank money, where you conduct the transaction is no longer bound by the territorial entity as they exist. So this is really overcoming where I think monies have remained tremendously local in scope and in utility. If we can make money what many of our goods and services are, namely truly global, then I think we can make a significant progress towards improving international payments. Another key project is the e-krona project, which is a retail CBDC, a project we are conducting with the Central Bank of Sweden, the Riksbank, and which is already in its second year. Here, the idea is to build a test environment to see to what extent can the retail CBDC serve, as a payment medium. The discussion about what is the utility of a retail CBDC, I share many of these concerns. I think a lot of the sort of advantages accrue to the central bank. It's very difficult to change sort of user experience with a CBDC. Unfortunately, most users will be completely different, whether they pay with a CBDC or PayPal or Apple Pay or debit card or credit card. The front end, is unlikely to change. But the back end could change quite dramatically. It could mean, a more diversified payment system, more autonomy, and maybe, less reliance in part on foreign card networks. These are a lot of the benefits that accrue, but again, they accrue mostly to the central bank. And I think that's a key driver for a retail CBDC. And then there's Project Coca 2 with the South African Reserve Bank. This is a wholesale CBDC project. And here the idea is really to look at, if we were to use a CBDC and we were to issue a tokenized debenture by the central bank, so how would we inject liquidity and absorb liquidity sort of in a blockchain environment? And then if we had a stablecoin, actually, how could we ensure that we have what is sometimes referred to integration or interoperability between the different mediums, you see? And I think what this project will illustrate, that this can all be done fairly seamlessly. I think a key concern is when introducing CBDC, we must preserve, of course, the integrity of the money market. So we don't want, a segmentation of the money market and therefore different pools of liquidity, but we want to make sure the singleness of the currency, of course, is preserved. And to do that, we need to make sure that there can be a seamless transition, between the token and the existing account-based world. And this is, I think, what this project will help to sort of to illustrate. So I think still a lot of work, obviously, needs to be done. But I think there are two types of central banks, seemingly, and I will conclude with that thought. There are some central banks who say, how can we make available a digital payment means to the general public, right? And there are many ways of doing it. the comment made earlier, let's just open a Fed wire account for every citizen is one way of doing it. We could have done it for decades, and we haven't, for good reason. And then there are other central banks who say, again, how can we make our central bank money, future-proof and ensure it can meet actual and future payment needs? How can we, bring more competition, more choice to payments? And what role can we as central bank do to be both a catalyst, but also to some extent, support for enhancing our payments environment? So I hope central banks will settle for the latter approach, and that we are going to see, this what is an expansion of money. I think CBDC, again, I'd like to conclude with a historical context. When banknotes were introduced, modern banknotes in the 19th century, so the free banking era in the US is a bit of a special sort of case, but in Europe in the 19th century, many people were extremely concerned about, banknotes, etc., when they replaced, specie payments, so gold coins and silver coins at the time. And yet, there was an urgency with, rising industrialization that we knew we need more modern payment means. And I think this is where we are today. CBDC is just like that. It's just like the introduction of banknotes, a new medium that hopefully will help us address new payment needs. Thank you very much. I'll stop here.
Thank you very much, Dr. Usman. Earlier in my introduction, I mentioned that the rise of privately issued cryptocurrencies is a threat to monetary sovereignty and poses risk on financial stability and price stability. So I would like to ask the panelists with us this afternoon, morning. Do you share this view? If yes, why? What makes it a threat? Or you don't necessarily hold the same view that it's not a threat after all at this time? Let's start with Benoit. What do you think, Benoit?
So thank you, Mert. That's a very good question. I don't really see cryptocurrencies per se being a threat to either monetary sovereignty or to financial stability, except maybe in very small open jurisdictions where that can be a temptation to use cryptocurrency as a substitute for the domestic currency, and that would be just a new form of dollarization. And it can be a matter of concern. The IMF should look into it, but that mostly applies to small open economies. For large open economies, I don't think cryptocurrencies are a significant threat as payment instruments, because namely for a very simple reason, which is just the volatility in their value and in their price. And so as there is many issues as investment, and certainly regulators are looking into it in terms of investor protection. There is also issues in terms of AML, CFT, money laundering, etc. But that's not a monetary discussion. I would see it primarily as a discussion on crypto as an investment class, which still raises many issues and open questions. Now, stablecoins are different, and that has been explained very well by Professor Skinner. They possibly hold the promise of being used as currency, provided that they are credible. And so you will need very strong requirements in terms of the quality and the creditworthiness of the reserve, and the legal and the solidity of the legal claim that you hold as holder of a stablecoin on the reserve. And that will need to be regulated, but provided that it is well regulated, I could see stablecoins emerging as a payment instrument. But that's a positive. That's a positive. We need diversity. We need innovation. We need diversity in that field. As I said earlier, I very much see central bank digital currency being at the heart of the system, just as central bank money is today at the heart of the system. But there is plenty of room for private innovation, provided that what is being offered with the promise of being stable is actually stable. And here, all the lessons that have been shared by Professor Skinner in terms of money market funds, the experiences with free banking, etc., they have to be kept in mind. So, but provided that the stability is effectively delivered, I very much see stablecoins as being part of the ecosystem, and for the better.
Any other views from our fellow panelists?
I'm happy to take this one.
Yes, Professor Skinner, please go ahead.
So, I think it's, and I'll also sort of offer some remarks to my other panelists as well. I think it's difficult to answer this question in a one-size-fits-all kind of way. I think it's very specific to each country, as is the decision about whether a CBDC is necessary or a good idea. I think in terms of monetary sovereignty, threats from either the private sector or the rise of other digital currencies abroad, I think, I don't really see that as a threat to monetary sovereignty in the US. We in the US have always had private money creation. Our banking sector privately creates money in the form of demand deposits. So that's really nothing new or concerning. As Benoit mentioned, I think the Fed welcomes innovation and diversity in that regard. Now, regarding the rise of digital currencies of other sovereigns, it's also hard to see how, the digitalization of a currency, just the mere sort of digitalization, is going to, threaten the US dollar. There are, and Vice Chair Quarles set this out in his speech as well, which I think is quite compelling. There are a number of reasons why the dollar is a global reserve currency that have nothing to do with whether it's digital or not, right? The strength and size of the US economy, the depth of our capital markets, the stability of the dollar, the credibility of our monetary policy, and the property rights and rule of law in the United States. So I think in terms of whether monetary sovereignty will be the motivating factor here, I don't think it's likely to. I don't think it's likely to. So I'll stop there, and if there's time, I can add some more there.
Mm-hmm. Any other views from our panelists? So if there are views like this that are held by some, yes, please, Dr.
So allow me to make one comment on the sovereignty, because I think it's a problem. Where the threat to sovereignty, I think, may be greatest. It's not the adoption of a stablecoin, because it's basically denominated in the same national currency, but it is where we see new units of accounts emerge, and like Bitcoin originally. So where we have a private currency that is floating against national currencies. This is where I think we could see that some sort of crowding out or replacement of existing currency areas, which are typically congruent with national territories, could be replaced or superseded by new currencies offering new units of accounts, and making it less important for a currency to be sort of in line with a given national territory. So if we see these overlapping currency areas denominated in new units of account, which I think is the key function of a currency in the first place, then I think we may have to rethink monetary sovereignty, because if we see to some extent a dissociation between territory and currency, well, then I think something new will indeed happen, and that could have implications for the role of the national currency as we know it.
So if that were the case, Dr. Uthman, can a sovereign digital currency be designed in a neutral way that attenuates fears about monetary sovereignty disintermediation and disruption in banking activities?
Is it directed at me? Okay.
Yes, Dr. Uthman, if you would care to answer that.
Well,
in fact, anybody from the panel could please answer.
Okay. Look, I think on the disruption, I mean, I think it is my working assumption that CBDC is a complement to existing central bank mediums. I see the role of disruption, if we see a significant adoption and substitution of CBDC of other, sort of monies in an economy. But it would have to be that extreme sort of scenario where suddenly, we see, a complete recomposition, not only of the monetary base, which I think is inconsequential, but mostly because, a recomposition of broad money. If we were to see that, then yes, maybe we would have to rethink. But it is, I think, only under these circumstances that the debate, really, merits traction.
Mm-hmm. Further to the earlier response you shared, Dr. Isman, I think Professor Skinner has a comment that Bitcoin is likely to, I'm reading, remain small given its desirability inherently linked to its scarcity. So what, Benoit, Dr. Mati, what do you think of comment from Professor Skinner?
Well, I don't have particular views on Bitcoin. As I said, I mean, when it comes to crypto in general, the use case of crypto as a payment instrument is severely hampered by price volatility, which is the value proposition of stablecoins, of course, to kind of overcome this impediment. So I don't really see any crypto emerging as a major payment instrument. But Mert, if I may, can I add just one small comment to what has been said on threats to financial intermediation and banks coming from CBDC?
Yes, please. Yes, please.
I think there is an important point to be made, that is that the baseline scenario that we have to start from is not what we see today, is what we will see tomorrow. And so what central banks are reacting to is not that much flows in the payment system as it is today. I mean, most jurisdictions have very well functioning payment systems, and they don't really need to be fixed. They're working very well, and that's mostly in commercial money, and it works very well. What central banks are reacting to today is to the prospect of 5 years, 10 years down the road, a payment universe that would be dominated by big tech companies with closed loop systems, a lot of market power, raising possibly privacy issues, and more importantly, fragmentation across different means of payment, stablecoins or likewise, which would be issued under different denominations and as closed loop ecosystems. And that would create fragmentation. That would be a threat to the singleness of money, as Usman put it very wisely earlier in the discussion, and that would prevent central banks from delivering what is their key social function, which is price stability and financial stability. So it's about preparing the future. It's not that much about reacting to perceived issues that we would be facing today, at least in advanced economies. In some developing or emerging economies, you have issues of the population being unbanked. You have issues of financial inclusion that probably needs some progress already today. So the use case, the value proposition is probably different in advanced economies and in developing economies. But it's the discussion about discussing the future is much more important than discussing the present or even the past.
Thank you very much.
Yes, may add something
yes,
on this.
please.
The question regarding the disintermediary causing by the CBDC. For us, especially for myself, I think that quite far away questions is not going to happen in the near term. And my worry now is that next year when we launch the CBDC, whether is anyone going to use it? That the main worry, the main concern, but not the large adoptions or the replacement of the banknote and this kind of things, or the replacements of the bank account. And I think that's the far-fetched scenarios. So that can happen if the adoption rate is very high. But at the moment, I think that, like in some country, they give a lot of incentive of people to use CBDC. The country I mean. So it, just the experimentation for Thailand at the moment. So I don't think that the question of this intermediary is going to happen in the near future. And I think if that's going to be the case, I think that we can decide to the use some kind of put the limit on the transfer, or the delay on the transfer to mitigate this kind of risk. But that really far away problem for us. Thank you.
Let me just jump in here on the US point.
Please.
So, I think at least here, the question really is why CBDC in light of what the private sector is capable of accomplishing. So a lot of concerns have been voiced around sort of pragmatism and the need for sort of faster, better, more efficient payments systems. And it seems like the private sector has that pretty well in hand. Also the need to use central bank money for more things. The need doesn't really seem to be there. Financial institutions are pretty happy with their accounts at the reserve banks and the way that works. And there's really no evidence that the Fed needs to catalyze the private sector because our private sector is so ambitious already. And I think big picture, sort of a lot of what I've been reacting to in my remarks has to do with this macro question of, should we be asking the Fed to do more? We're already asking the central banks to do a lot. And the retail CBDC goes hand in hand with things like Fed accounts, and giving everyone an account at the Fed to access retail CBDC would, and this connects to the disintermediation point, that would radically change the landscape of banking and central banking as we know it. So, over the years, since the Fed was founded in 1913, Congress has taken a number of concerted steps to make it clear that the Fed is not supposed to be competing with the commercial banking sector. So the Fed used to have this kind of industrial lending role. The Congress revised the Federal Reserve Act in 1957 to get rid of that. And so I think we have quite a distinct landscape that would be, really changed by the introduction of CBDC. And I'm not at all sure it's about big banks' relationship with the Fed. At the founding of the Fed, the big banks did want the Fed. It was the agrarian interest, the little guy, that was worried about being cut out of it. So I think the concern is really coming from pulling the retail deposits out of the banking sector, and not necessarily about increasing the sort of milieu of payments options.
Mm-hmm. I'll take one question from the audience, and this one is a question for you, Professor Skinner. Question goes like this. If there's a stable coin or a CBDC which becomes globalized and begins to be used as an alternative to the US dollar as a global payment currency, what would be the reaction of the Fed or the US Treasury, perhaps?
That's a great question. That would be very difficult to answer in 2 minutes. But people are certainly thinking about that. And I think the first reaction is, well, we have very deep dollar markets abroad already, right? The euro dollars market is huge. The Fed backstops US dollar funding markets with swap lines. So the fact that people use things that are denominated US dollars abroad is not really that new. It could make things difficult for US residents for a time. And it would certainly have to be a policy question that the Fed and the Treasury would have to think about when they think about these dollar markets abroad. Some people call them sort of the dollar shadow banking market abroad, but it doesn't move the needle that much, I think.
Thank you very much, Professor Skinner. And since
can I react to this?
Yes, please, Dr. Usman.
Allow me just a quick comment, because I think that we need to understand the special role of central bank money. So, central bank money is the safest money. And so there are certain applications, and typically for financial market infrastructures is where central bank money should be used for settlement. That's the use case for central bank money. So it's not about making payments more efficient. it is where central bank money plays a special role. Can we extend that role to a broader environment? That is the key. I'd like to stress here. And this is why there is no substitute. You see, it's not that the private sector is doing something nice. It is, you know, central bank money has a special role, and it is that role I think we need to emphasize.
Thank you, Dr. Usman. So, given your response, Dr. Usman, do you mean that therefore wholesale CBDCs would not be as impactful as retail CBDCs?
No, on the contrary, I think you know, where CBDC is likely to play its biggest role is going to be in wholesale, but in particular in international payments. And the advantage of, you know, the CBDC, it is both payment instrument and settlement infrastructure, and it is that advantage which brings really needed innovation in payments, in particular in international payments.
As it is almost time, I would just, and since I'm sure we have members of the audience who are about to launch or are designing their pilots or experimentation for CBDCs, I'd like to draw on the experience of DG Mati and perhaps Dr. Usman, because you've implemented CBDC projects yourself, and also well, even Professor Skinner and Benoit, as you have seen many of the experimentation. So, what are the design features that are least disruptive then? How should the central banking community proceed with the issuance of digital currency? What's your response to that, DG Mati, based on your experience?
Well, I think these high-level policy questions, you know, even in our team, there's still some disagreement. Even the one who developed the CBDC in the projects, you know, how far we should go, in which directions, and design and model that we're going to use. So I think it's really country specific, and but you know, just to learn the you know, how to apply the new technologies, digital you know, monies, just the way to learn the new type of you know, the instrument, and it's not only the money, but also the infrastructure, digital infrastructure, the DLT, and the related technology. So we can learn a lot from the hand-on experience, not only the CBDC itself, but you know, you can learn how the private sector think about the digital currencies. We can, you know, use the interoperable features between the central bank CBDCs and private digital currencies in the future. That may be, you know, the good use case that we can explore going forward. Thank you.
Yeah, thank you very much, DG Mati. Our time is up. So before we close, any parting words from our panelists? Benoit, can we start off with you if you have any parting words?
I think a lot has been said, and you know, I think the conversation on CBDC doesn't deserve the anxiety that it sometimes creates, particularly in the banking community. CBDC is very much about keeping the system as it is today. Central bank money are being used as a settlement asset in large market infrastructures, and being provided as a payment option to citizens, but only as an option. That's what we have today. We want to keep it for the future, and for that we need to embrace technology. But it is not a plan to change in a fundamental way the way financial intermediation works. And if it is, then we're in trouble, and then we have to deal with it, and we've got to change it. But the way I would see CBDC is really technical adaptation to the digital world, but not a fundamental project to change financial structures.
Professor Skinner, any last word, parting words on our topic for this afternoon and morning?
Thank you for having me. It's a pleasure to, be a part of such a vibrant, timely debate. I look forward to following the debate. Like I said, the US Federal Reserve is certainly considering these issues very carefully, and they've promised a discussion paper soon. So for those interested in what the Fed is thinking, you can expect to see that any day now, I think. And thank you for letting me play my role as a professor and provoke thought in the most contentious ways on this issue.
Yes, thank you. And we'll certainly watch out for that discussion paper coming from the Fed. Dr. Usman?
I'd also like to stress that CBDC, I don't think is as disruptive as sometimes it's being portrayed. I think the emphasis is, it is modernizing central bank money, and it's likely to play an important role where central bank money really matters, and that tends to be large value payments. Maybe one point of clarification: when it comes to the distribution of a CBDC for the general public, it does not have to mean that the public has an account. Benoit illustrated the three different approaches. In Sweden, I think we implement what Accenture developed as a benchmark approach, namely a distribution via financial intermediaries, in large part precisely to preserve existing monetary relations in the economy, and also, more importantly, to keep banks and maintain banks as key intermediaries in the system. So that is entirely compatible with CBDC. Thank you again for having me.
Thank you too. And finally, DG Mati, your final thoughts on path towards digitalization of money?
I can't hear you clearly. Can you repeat the question again?
Sorry, DG Mati. So for your parting words, any further thoughts on the path towards digitalization of money?
Well, I think it's not easy to answer these questions. Well, I think since the history tells us that during the free banking era, it's just like everyone can issue the money, and it depends on the credibilities of the issuer. And then we come to the centralized system. And then now I think the private sector try to do everything decentralized, not only regarding the digital money, but all the financial system, and like the DeFi and these kind of things, they try to get rid of the authorities. So I think this question is very real, and I think it will change the way for the central bank and regulator on how to regulate this kind of innovations, and perhaps in the future the banking system and even the central bank themselves will have a really big challenge on their roles, on their duties. I think in the near future. That my thought on this.
Thank you very much, DG Mati. I'll definitely be in touch, as we are also charting our course for our own journey into CBDC. So thank you very much to all our panelists. It's been exciting and very informative. And as Professor Skinner mentioned, those are very thought-provoking views indeed. And we certainly would like to learn more, perhaps have a read of the discussion paper that's coming out. And also, I'd like to keep in touch if I can with our distinguished panelists, as you've all gone through some a lot of thinking and even experimentation into this subject. So thank you, and thank you to our audience, and thank you to our panelists. So good day and good evening for us.